Hey gang, welcome to Time in the Market, the investing channel with a long-term focus, taking a look at Warner Brothers Discovery, ticker WBD. This is my smallest holding. It's actually a bigger holding this morning because I bought more shares at $8.30. That was kind of my trigger. It's up to about $8.60 right now, down 10% for the day. If you're a long-term holder, since the split with AT&T, this has been a dog, down 65% in the past 5 years. So why is the stock down today? Well, earnings kind of sucked. They missed on the top line and the bottom line. They did generate good free cash flow, but some of that is because of the strike and the fact that some of those expenses were just pushed forward into another quarter. So revenue down 7% in Q4, EBITDA down 5% in Q4, cash flow looking really good, but that's acceleration from the losses seen earlier in the year. Overall down 4% for the year, up 12% on the EBITDA side. So that's a bit worrisome. And I think investors are looking at their performance in the studios, but especially in the networks, and kind of wondering, is this the new norm? Are they shrinking faster than we thought they would shrink on the network side and not really offsetting it with profit on the direct consumer side? So studios, always going to be a variable business. Depends on how successful their theatrical releases are. Some of them are good, some of them are bad. Obviously, Barbie was really successful this year, but then movies like Aquaman, not very successful. You've got Dune 2 coming up ahead. I think that's going to be more of a quarter 2 play. Expenses falling into quarter 1, but Dune 2 seems like it should be really successful, well reviewed. On the games side, they have a games company as well. Hogwarts Legacy was very successful this year, but then they just released the Suicide Squad to middling reviews, poor success, and I don't think that game is going to be what they wanted it to be. So revenue is going to be variable here. So the fact that it's down 18% could be up more in the future. But for the year, studios down 12%, which is also not very successful, despite the release of Barbie, but also part of that is because of the strike, and part of these results also because of the strike. That certainly has a big impact due to licensing deals and other things that may be comparable against in the prior quarter. Then you've got your network side of the business. This is really where the worries start to arise. Revenues down 8%, adjusted EBITDA down 11%, distribution down about 3%, advertising down 14%, which is a huge hit. Again, less and less people are subscribing to pay TV, so they get less affiliate fees. That's just what's happening, and that number is going to keep coming down, and that's a problem because this is where they make the majority of their money. The majority of their free cash flow comes from networks. Then on the advertising side, they're talking about softness in the linear advertising environment, both in the US and in other markets on the international side. And I don't think the problem is as much demand, but it's maybe supply. You no longer have to go to linear TV to get access to a television audience because Netflix has an ad-supported service now. So does Amazon Prime Video. So does HBO Max. So do a lot of these other players. Disney Plus, ad-supported everywhere. There's just so much supply that even if demand goes up or stays the same, they could see weakness and softness in their advertising business. And that's a problem. That's a big problem. If it's shrinking fast, that is going to mean that they generate less and less free cash flow, that their top line grows less and less because their DTC business just isn't growing fast enough, up just 3% for the quarter. Adjusted EBITDA is positive, but the issue here is that it's not growing, it's not offsetting the losses that are happening on the network side. If you look at the overall year performance, studios down 12%, networks down 8%, DTC up only 5%. This should be growing faster. This should be their growth engines. And the problem is what they're doing is that they're not really investing in growth, but they're cutting back on costs to show that their DTC business is actually profitable. And it's like, yay, we're profitable. We didn't lose $2 billion this year. That's a good thing. But that's true. It is a good thing. But if this is all you're going to get, are you going to be able to cut back costs any further, or are you just going to grow at a very small clip when the other parts of your businesses are shrinking at a high single-digit number and they're a bigger part of the business, right? Networks is $9 billion of the $10 billion in EBITDA that you have, maybe $8 billion if you adjust for the eliminations, and it's shrinking at 10%. So what is this going to grow at? Is this going to be able to grow at $1 billion to offset the losses on the network side? I think the answer is no, especially when you're only getting $500 million in additional revenue every single year. And the problem is they're not growing on the domestic side. They're actually down 2.6 million subscribers since Q4 2022. And yes, they're up about 3 million subscribers on the international side, but the international side makes you far less money. The domestic side is where you make a lot of money. How do they change that? They talked about the drought of content due to the strike. They think they can grow this on a go-forward basis. They're expanding into more international markets, the Latin American markets. France and Belgium are going live in 2024, and they still access only about half the markets of a company like Netflix, so there's plenty of runway ahead of them. But can they grow on the domestic side? Where's the content? My main concern is also that they're licensing a lot of their content now in 2024 to their competitors. Netflix has a lot of HBO stuff now. And if you look at the top 10 list of popular shows on Netflix today, probably, some of them are HBO content that wasn't that popular on HBO for whatever reason, but is very popular on Netflix because Netflix does a better job of curating their content and actually releasing content quickly and all of the time. Whereas HBO Max does have new content, but it doesn't seem like it releases constantly. They just need a new slate of content all the time to grow. And they're not doing that. They're not concentrating on content spend. They're concentrating on saving money in order to generate free cash flow, in order to pay down debt. And in the short term, that kind of looks crappy. Because it's like, well, you're not growing on the DTC side. Yeah, you're profitable, but your top line is actually shrinking because your other businesses are shrinking. And your bottom line looks okay because you're cutting back on costs, but that comes at the result of not growing your DTC business enough when that's what you need to do in the long run to offset the shrinkage in your linear business. And that is a problem to me. If you look at their free cash flows, they do look pretty good. If you look at their actual bottom line results, they look okay. But if you kind of look under the hood, the growth just isn't there where it needs to be. And the network side is a sinking ship that they're trying to get as much out of as they can, but they don't seem to be investing in growth in areas where it really matters. Like, you need to grow that DTC business. It needs to be self-sustaining and growing at a much faster clip than 5% a year where it is today. It just needs to grow a lot faster in order to offset these businesses that are shrinking. And it's not doing that. That's the problem. It's not doing that. And I think that's what the market is reacting to. The call itself was kind of in the same vein. They asked specifically, well, what are your expectations for free cash flow? And the answer was, we're not really giving any details to that right now. They didn't really give any specific guidance for Q1 besides saying that Q1 right now looks pretty good versus what it was last year. So I think the expectations are that maybe 2024 is going to be similar to 2023 in terms of bottom line free cash flow, at least, without the $1 billion benefit of the strike that they got this year. So maybe in that $5 billion range, they're going to continue to pay down debt. And my thesis with this stock has always been they're going to pay down debt. The free cash flow yield that you're getting on this is really, really good. And when they get to a spot where their debt is very manageable and the market notices that they're actually still generating free cash flow and maybe at that point growing free cash flow and maybe at that point being able to invest more in content to grow their overall business and also make some acquisitions and or buy back shares, then the stock price is going to go up. But that is a long-term thesis. They need to prove that out. They haven't done that yet, and that's why the stock is suffering. They're not growing DTC. Free cash flow is there, but it's not growing, and it's questionable whether or not they're going to be able to grow their revenue into 24, into 25, into 26 with the growth they're seeing on the DTC side and the shrinkage they're seeing on the other parts of their business. So as we look at the valuation here, again, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence before investing in any stock. Let's look at my valuation here. And the last time I looked at this, I had this valued at about $9.50, but there were some assumptions around growth. There were some assumptions about free cash flow, margin expansion that I think were a bit too optimistic. I think I had something like 2% growth going forward. Given that they shrunk at 4% on a pro forma basis in 2023, I think the expectations are that they're not really going to grow in the next couple of years. They're not focused on growth as much as they should be. They're focused on paying down that debt as much as possible. And that means that they're cutting down on expenses in order to generate free cash flow. Whether or not that's a good thing is a question mark, but they eventually need to start growing in order for this stock to be an interesting investment. And right now I have this at growing at maybe 1% in 2024 and then being flat for the next couple of years with margins expanding a little bit. And I think that's a pretty reasonable assumption given what we saw in 23, maybe a bit pessimistic, but at the end of the day, I don't think this is a stock that requires that warrants an optimistic viewpoint given what we've seen in the past 1 or 2 years on the growth side. So as I look at this, as I kind of look at their current free cash flow yield of 29% on a market cap basis, of about 10% on an enterprise value basis, because they're paying down that debt at a pretty good clip, because they're continuing to generate free cash flow, I think the free cash flow yield is a bit too pessimistic right now. I mean, 29% is crazy, 10% is pretty good. I think as they pay down this debt, some of this enterprise value moves into the market cap and this stock starts rising again. But I'm kind of putting this into that 15 to 16% free cash flow yield from a mature standpoint, which is probably honestly pretty pessimistic. If they continue doing this, even if they're not growing and they pay down their debt and they eventually start growing, this could be a stock that returns multiples of what it is today. But I'm being relatively pessimistic here because this company hasn't given me anything to not be pessimistic about with how it's presented its results in the last year, what kind of guidance it's given, the growth of their direct-to-consumer business being lackadaisical and mediocre, the investments they're making in the business being kind of mediocre as well, and the shrinkage kind of accelerating on the network side. You have to be pessimistic here, and you kind of say that, hey, if you want a 10% return with these assumptions, the fair value is about $8.95. It's trading at $8.64 today. If you want a 15% return, given that this is probably a riskier bet, you get a $7.17 price point. So it's kind of in that range. Like in my mind, if this stock is trading kind of in that $7 to $8.50 range, to $7 to $9 range, it seems like a fair value of this stock. But management does need to actually execute on some of their strategies. Yes, they are paying down debt. Yes, they generated a ton of free cash flow and used it to pay down debt. They're probably going to generate a bit less free cash flow because you don't have that strike benefit going forward. Maybe margins will expand as direct-to-consumer expands a little bit. But you also have to assume that they have to make further investments into their direct-to-consumer business, which might put pressure on margins. You also have to assume that there's going to be pressure on their networks business, and their studios business is going to be variable depending on how successful their movies are. Is Dune going to be a success? Dune 2 going to be a success? Is Godzilla vs. Kong going to be a success? Is their licensing going to be a success, or is that going to devalue their offerings on the streaming side? Is HBO Max devalued because a lot of their content is now on Netflix? Those are the questions you have to ask yourself, and that's why this isn't a huge position for me, even though it looks so good on paper. It's like, wow, 30% free cash flow yield on a market cap basis, 10% free cash enterprise value free cash flow yield. That's huge. Their debt, it's only $1.8 billion due in 24, $3.1 billion due in 25, $2.3 billion due in 26. I think they're going to pay down more than that every single year. Their target is 2.5 to 3x. Right now they're at 3.9x of their EBITDA. They're probably not going to hit that in 24, but maybe in 25. Can they actually hit $1 billion in EBITDA on their DTC business? How successful will this joint venture with Disney and Fox be? I could see it being very successful because people want that type of package. I think it's going to be priced at like $49.99, but it could also go out there and go over like a fart in a room where people just kind of, maybe some people subscribe to it. They get like 500,000 subscribers. They decide it's not worth it and it just kind of dies down. There's also going to be pushback from companies like Fubo, which are suing this joint venture to block this joint venture. I don't think the cable companies are very happy about this because this is a service that they do want to offer, but they are not able to. So if this takes away from cable subscribers, obviously these companies say it won't, that they're targeting the 60 million people that want sports but aren't able to get it through a traditional non-subscription service, and they're not subscribed to cable already. So if they can get a lot of those subscribers on board, if WBD can get a lot of subscribers on board with their Bleacher Sports add-on. Obviously, there's a lot of question marks around their sports networks, sports contracts as well. There's the NBA contract coming up for negotiations. Those have been very competitive. How much are they going to have to pay for that? They already spend about $20 billion or so on content a year. If that number has to go up because they want to keep the NBA, how is that going to flow down to the bottom line? How can they offset that when the revenue shrunk this year? Is their revenue actually going to grow 1% next year? Or am I being too optimistic? Is this going to be a company that's going to continue shrinking every single year? And if they do, the fair value here could be as low as $8.17. So these are assumptions you have to think about. As they pay down debt, can they start buying back shares at a rapid pace, right? They are probably going to generate $26 billion in free cash flow in the next couple of years. Most of that is going to go to pay down debt. Is the stock price going to actually reflect the fact that their enterprise value is shrinking along with their debt? Or are they going to be able to buy back shares at a really attractive valuation when they get into a better spot with their balance sheet? On top of that, can they invest in other companies as well when their balance sheet is more healthy? A lot of these companies like WBD are just poorly valued right now. Will there be another merger coming up? Comcast plus WBD, Paramount plus WBD. I wouldn't really want that to happen. I want this thesis to play out on its own, and I'm not too upset that in the short term this stock is being hit, but I am kind of worried that their direct-to-consumer offering is not growing as fast as it should be. And if I look at this in Q1, in Q2, and in Q3, and direct-to-consumer is still looking kind of crappy, is this a stock I could give up on and kind of say, well, I'm going to wash my hands, take the losses, and walk away because this thesis is maybe not going to play out like I thought it would? Yes, I think that's a possibility. But for now, I'm still interested in this stock. I still think it's an interesting valuation. I'm not going to make it a huge position, but if it stays in the $7 to $8 range, like I said, I bought more at $8.30. Will I buy more? Yeah, probably. I think it's an interesting stock. I think it's an interesting long-term play. But in a market like this one, where it's growth at all costs and growth companies are rewarded, companies like this are kind of not rewarded and pushed down to nothing, to terrible valuations. And it may take a while for that to change. This is a stock that could be pushed down to 7 to 6 to 5, and I wouldn't be surprised by that. But if this stock is trading at $30 in 2026, when the mindset of the market changes, would I be surprised by that either? No, not at all. So that's my thoughts on it. Let me know what you think about WBD. Do you agree, do you disagree? Let me know down below in a comment. If you liked the video, hit the like button. If you're new here, hit the subscribe button. And hope you enjoyed and watching the video, and come back again another time. Thanks for watching. Bye.